Then I'm breaking down the not-so-stable world of stable coins and telling you why it could be time to at least stay focused on this difficult issue, and why some action in the crypto market reminds former CFTC Director Tim Masson of what happened during the 2008 financial crisis. Oh, you're not going to want to miss this. So, don't go against my ma and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. Don't make a move until you hear Cramer's take on one of the most critical crypto caveats out there. Next.
All right, everyone's talking about cryptocurrency. Got a whole show tomorrow devoted to it. Well, we got to talk more about it. See, because it's finally gotten so big that we need to start caring about the whole crypto ecosystem, not just whether it's Ethereum or you like Bitcoin. See, there's just too much money involved to ignore any potential vulnerabilities. Right now, we've got some very smart people pointing to a major weakness in the system. I'm talking about so-called stable coins, the largest of which is something called Tether. These stablecoins are pegged to traditional non-digital assets. You know, we might think the U.S. dollar, bonds, gold. Tether's grown to become the third largest cryptocurrency behind Bitcoin and Ethereum, and it's got a market cap of more than $60 billion with a B. Why do we care about this thing? Because Tether's now a key source of liquidity for the entire cryptocurrency ecosystem. The irony of crypto is that most of these things are too volatile to use as currencies. Bitcoin was up about 10% today, which is great if you own it as a speculative asset, something I've recommended to you repeatedly. But that kind of swing is terrible if you want to use Bitcoin as a medium of exchange. And that's where these stable coins like Tether come in. Tether's more or less pegged to the dollar, emphasis on more or less. So you see lots of people trading between Tether and Bitcoin or Ethereum, then using Tether to conduct actual transactions, often very leveraged. In the last 24 hours, Tether accounted for roughly 14% of all Bitcoin trading volume and nearly 16% of all Ethereum trading volume. Think of it as the biggest link between the crypto economy and the real economy. Now, though, incredibly thoughtful people, I'm talking about people like Timothy Masson, the former head of the Commodity Futures Trading Commission, and the guy who oversaw the Troubled Asset Relief Program during the Great Recession, are pointing out that there could be some serious flaws in the system. He's concerned about Tether. More on that later when we actually speak to him, and it's going to be right after the break. And the company behind Tether, which is also named Tether, has been banned from doing business in New York by the state attorney general. That's a pretty draconian penalty, given that New York is the home of Wall Street, don't you think? You know what that means? You take a closer look. Now, before I get into the weeds, let me be clear. I am a huge believer and supporter of crypto. I think it is a good idea to put 5% of your portfolio in Bitcoin or Ethereum. I think stablecoins are a terrific idea. I have a portfolio of crypto. I'm not trying to attack crypto here. It's the opposite. I want a healthy crypto ecosystem, in part because of your investments and mine. So if there really is a problem with Tether, it needs to be addressed. Maybe it needs to be rooted out. Maybe transparency would make it so we're fine. So let's go over the issues. I told you Tether's the link between the crypto economy and the real economy. Some experts are worried it's a weak link. The whole point of Tether is that it's supposed to be backed by real assets. Originally, the company behind the thing said, I'm going to use a lot of quotes here because I got to get this right, Tether's currency is 100% backed by actual assets in our reserve account and can be viewed and verified in real time. End quote. Then in 2017, they started saying, quote, every Tether is always backed one-to-one by traditional currency held in our reserves. End quote. The idea was that these were like digital dollars. You could move around even faster than regular currency. It's faster than a wire transfer. However, in early 2019, Tether changed the language on its website. Quote, every Tether is always 100% backed by our reserves, which include traditional currency and cash equivalents, and from time to time may include other assets and receivables from loans made by Tether to third parties, which may include affiliated entities end quote. Now, while Tether's still pegged to 1-to-1 to the dollar, suddenly you have to wonder if that peg could be in jeopardy. A few months later, the New York Attorney General, no slouch, noticed that new language, started coming after Tether, along with Bitfinex, which is this cryptocurrency exchange that's run by all the same people. These prosecutors alleged that Tether and Bitfinex had commingled funds. Basically, Bitfinex lost money, so it borrowed hundreds of millions of dollars from Tether's cash reserves. Less than ideal. As part of the initial court proceedings, Tether's general counsel revealed that their stablecoin was only 74% backed by cash and equivalents. So Tether's not just sitting on a big pile of currency. It's also got loans and securities and all that stuff, and that makes it more risky. At this point, nearly half of their assets are in commercial paper, short-term, unsecured corporate debt. Now, we don't know which corporations, and even though Tether is gigantic, we don't hear much about them playing in our very liquid commercial paper market, which is curious. If at some point the economy goes into a tailspin, some of these corporations default on their obligations, Tether might not be able to maintain that 1-to-1 peg to the U.S. dollar. Little extreme, but I've got more. Now, earlier this year, Tether settled its case with the New York Attorney General, and this has become a major point of controversy. Tether and its supporters argue that they didn't do anything wrong. Well, they didn't admit wrongdoing. It's true. They only got an $18.5 million slap on the wrist. That's not much. But they also got barred from trading with people in the state of New York. And when you go through the settlement, there is some wild stuff in here. First of all, the settlement agreement says that Tether misrepresented the status of its reserves from late 2018 through 2019. Misrepresented. When they changed the language on their website. Their sister company, this BITFINEX, lost $850 million to a Panamanian shadow bank. So they borrowed a fortune from Tether. Remember, both companies have the same CFO. And for a while, Tether's coin was partially backed by that loan, although it's since been paid back. Tether also agreed to start disclosing its reserves on a quarterly basis. We got those numbers last month. But all they gave you was this one-page document with 2 pie charts. Left more questions, frankly, than answers. Turns out only 3.9% of Tether's reserves are in actual cash, even if you want to be more generous by including Treasury bills and reverse repo notes. It's still only a little more than 10%. Just under 50% is commercial paper. Again, don't know the names. Given the size of Tether, that makes them one of the largest holders of commercial paper in the world. But why? How about the names? There's nothing wrong with a stable coin backed by short-term corporate debt. But we need to know whose debt we're dealing with. According to Tether, the vast majority of its commercial paper is rated A2 or above. I'd much rather have some actual numbers and the real issuers. Why not? If they're all A2, what do we have to worry about? Don't just give us the breakdown. Tell us who they are. Now, Tether also brought in an accounting firm, the Cayman Islands. I've been to the Cayman Islands, they're beautiful, to issue an assurance opinion that gave them a clean bill of health. But that's not the same as a real audit. So how stable is Tether? Honestly, I don't know. That's kind of the problem, isn't it? Tether's become a pillar of the crypto economy. Not only does it make up a huge percentage of Bitcoin and Ethereum trades, it's also frequently used as collateral for leverage trading. That's right. And there's a ton of leverage in the crypto system. Sometimes 100-to-1 leverage. So if there's ever a problem with Tether's reserves, you could see a massive unwinding event instantly. And there are no regulators who could step in to mitigate the damage. It's not like it's run by the Treasury Department or the Fed. Of course, this is a low probability event, but it's not changing my belief in crypto. I'm in there both for speculation as a hedge against inflation. You would most likely only see a real run on Tether if the Chinese shut down their crypto shadow economy. Could happen. Or if there's a huge downturn in the economy jeopardizing some of that commercial paper, or if some further government investigation reveals things that the New York Attorney General somehow couldn't dig up in 2 years. But given the importance of Tether to the rapidly growing crypto economy, we need more transparency here, especially because I am worried about China. Tether, why not just open the kimono, agree to be audited by a traditional U.S. accounting firm, make us not worried if China shuts down their market. Bottom line, when you get past all the complex terminology, this is a pretty simple issue. Either Tether's reserves are legitimate, liquid, and stable, or they're not. That wouldn't be in question if we had more insight into what they're actually holding. That's why I'm begging them for more transparency, so we can put this whole thing to bed and erase what some very smart pro-crypto people fear is the weakest unregulated link in an otherwise very strong but unregulated chain. Total transparency takes the biggest worry to the crypto world I love off the table, provided that what it shows is as legitimate as Tether says it is. After all, if it is, why not just show us? When we come back, more on the curious case of a gigantic unregulated financial company that is so key to the crypto world, as seen by Tim Massad. Let's take some questions. Let's go to Alex in Maryland. Alex.
Jim, pleasure to be on the show. Thank you.
And I'm sorry, glad you're on the show.
Great show, great investor tips.
Thank you.
Talking about Marathon Digital, ticker symbol MARA. Let me give you some facts. When Bitcoin was $19,000, Mara was trading above $40. It's now trading around $26 with good liquidity, about 15 million trading shares per day. Mara recently spent some profits to increase mining power to 10.4 EH. Layman terms, they're going from 30,000 miners to 100,000 miner machines. By the time all miners are operational, they'll be mining about 60 Bitcoin a day at the expense of $5,000. They've also locked in a contract with an electrical company to limit power costs. Assets include over 5,500 Bitcoins, obviously assuming Bitcoin staying at current rates about $35,000 or higher.
Okay. Well, look, I mean, that sounds like an interesting spec on Bitcoin. I mean, to me, if I want to take that, look, it's an interesting spec on Bitcoin. I'm not going to say more than that because I don't know the company. I mean, to me, if I want to know mining of Bitcoin, then it's a small part of NVIDIA because they have Ethereum mining cards. But maybe I'm too conservative for you, but look, I certainly bless that if someone wants a play on crypto mining. Hey, I like Barrick. That's a play on gold mining. All right, maybe a little disingenuous there. All right, two things are very certain. Tether has become a pillar of the crypto economy, and the legitimacy of its reserves, let's call them unclear and suboptimal. We need more transparency from them. Now, much more Mad Money Head. My conversation about stablecoins doesn't end here. I'm taking a closer look at the weakest link in the crypto chain with former CFTC Director Tim Massad. Then, what should you do with anecdotal evidence in this market? I'm going to give you my take. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Just before the break, I gave that primer on what many people consider to be the biggest risk to the crypto economy, the concerns about Tether, and also some other so-called stable coins that are more or less pegged to real-world assets. But this is a thorny two-sided issue, though. So I want to dig deeper with Timothy Massad. He's the former chairman of the Commodities Future Trading Commission and the man who oversaw the troubled asset relief program at the Treasury Department during the financial crisis. He's now a research fellow at Harvard's Kennedy School of Government. Last week, Massad published a piece arguing that if there's some kind of shock, these stablecoins might experience a crisis akin to what happened when a major money market fund broke the buck, so to speak, in 2008 because they owned a bunch of Lehman Brothers paper that suddenly became near worthless. Back then, the Treasury Department saved the day by backstopping everything. Now, I got to tell you, I don't see them doing that for cryptocurrency. Because this topic is too important to ignore and because I like cryptocurrency so much, let's take a closer look with Tim Massad to get his read on the Tether situation. Mr. Massad, welcome back to Mad Money.
Jim, it's great to be here. Thank you so much for having me.
Well, thank you, Tim. You know, I like crypto so much. And when I started reading about this Tether, I said, wow, I got to go to a man who knows more than I do to find out whether the risk is real and how it could really hurt people's, let's say, holdings in crypto, but more importantly, the world of crypto and whether it's stable enough because of Tether.
Right. Well, you know, Tether has become very important in the plumbing of the crypto markets, you know, and it's grown to a $60 billion market cap. And look, you know, some people think all of crypto is like gambling, right? And I wouldn't say that. But in that analogy, Tether's kind of like the chips you get, you know, when you go to the cashier, and it makes it a lot easier to move from game to game. And, you know, you don't keep cashing in and out of dollars. You just move your value around through Tether. But the problem is what Tether is doing with the money that you use to purchase the coins. And we now have a little bit of disclosure about that. And while in one way you could think of it like a money market fund, one token equals $1, it's supposed to be invested in very stable things. In fact, you know, they're investing in stuff that it's not clear whether they could really liquidate it quickly and liquidate it at full value. So, you know, as long as a lot of people aren't demanding their money back, there's not an issue. But if suddenly a lot of people did, I'm concerned there would be an issue.
Now, when I get the statements from the very nice people at Tether, they tell me, look, we've got much more transparency. You realize we've changed a lot. But then I read that New York, the AG settlement. And they basically got kicked out of Wall Street, of New York. And to me, Tim, that's highly unusual. And you went to law school with me. If New York decides you can't do business here, shouldn't we be more worried than most people are about this thing?
I think we should be. And, some people might say, oh, well, the AG didn't impose that big a fine. And that's true. But the important thing is the AG required some disclosure. And now when you look at that disclosure, that's when you get concerned. 13% of their assets, this is 13% of 60 billion, is invested in secured loans. We have no idea what kind of loans those are or who they're to. Now, they claim 50% is in commercial paper. That's a lot of commercial paper. But, I've talked to a couple of people who are involved in trading commercial paper. They're not sure they see Tether in the market. So I don't know what commercial paper Tether is buying. But, it's all a concern. So I think we need more disclosure here.
Now, one of the things I think people are going to say is, who cares? I mean, this thing's not that big. Tim, I got to tell you, when I first heard this, I was shocked at how big Tether is.
Yeah. No, that's right. I mean, and a lot of people would say, oh, crypto, it's let the buyer beware. It's caveat emptor. I don't take that view. First of all, I think integrity in our financial markets is important, number one. Number two, you never know the linkages. And increasingly, the crypto world is more and more connected to the mainstream financial sector. And Tether really is kind of tied into our payment system, if you will. It's a digital dollar in many ways. So I think we do need to be concerned. And I think, we need a better framework of regulation for Tether and other stablecoins. And that could be like a money market fund where, you can only claim it's a stablecoin if you invest the money in high quality liquid assets. It could be bringing it within the banking sector, where it has to be issued with a bank, and the bank has to have it backed by deposits. You could even say those deposits have to be parked at the Fed. There are other in-between measures as well. But we need a better framework so that we can just be sure that there can't be a run on something like this.
Well, Tim, what do? We've got a world that really doesn't want regulation because they think regulation, frankly, is not worth the price it's printed on, so to speak. And then you've got, but you have people like you and me. I mean, I like crypto very much. When I started reading about this, I immediately called where I keep my crypto. And I said, you're not involved with Tether, are you? And they said, no. And I said, well, that's a relief to me. At the same time, there's most people who say that I'm just being ridiculous, that this is no chance that this could cause a risk. So, Tim, how do we really weigh the risks of this darn thing?
Right. Well, and, I think there are a lot of people holding Tether who very much like the fact that it's not regulated, that there's some opacity to it. You don't know for sure what's going on, and particularly because a lot of the money going into Tether is coming from overseas, perhaps from countries that have, capital controls or regulatory restrictions that would not allow people to do what they're doing. Look, my view is always that in the long run, a sound regulatory framework is better for financial markets. We've seen this movie over and over, where people said, oh, not to worry, subprime mortgages and the derivatives on those, it's small, it's outside of the mainstream banking system. And, look what happened. I'm not saying we're due for that with crypto or with Tether. I'm just saying I think a sounder framework of regulation would be better in the long run for the development of this industry. And I'm perfectly happy to have people invest in crypto. I don't know where it's going. But I think the technology is exciting. There could be potentially very important applications of the technology. I mean, look, we're suddenly talking about central bank digital currencies. That wouldn't have happened but for Bitcoin, which led to things like stable coins, which is now causing, central banks around the world to think about central bank digital currency. So that's all good. Financial innovation is good, but we need a good regulatory framework around it.
Well, let's just leave it at that, because that's exactly what I think would make everyone more comfortable with crypto. And that's what we need. I want to thank Tim Massad, former CFTC chairman and now Harvard Kennedy School research fellow, and yes, an old friend and classmate at Harvard Law. Tim, great to see you.
Jim, great to see you. Thank you so much for having me.
Thank you. Mad Money's back after the break.